Hey, this is 1001 Investing Channel. We are here with tips and secrets about investing. So please pay attention to this audio. How to use moving averages. I have one strong rule, and that is when it comes to a stock, if it's above the 200-day moving average, I'm gonna be long it, and if it's below it, I'm either not gonna own it or I'm gonna be short it, period, end of story, and I just let that govern every single thing that I do. Paul Tudor Jones. In this lesson we will learn trading with moving averages instead of fundamentals, using moving averages as a reactive technical analysis tool, entering trades using moving averages, exiting trades using moving averages, capturing trends with moving averages. While fundamental analysis is the study of a market's potential value, technical analysis is the study of the behaviors of the participants trading in that market. Investors are primarily focused on valuation metrics for an asset, while traders primarily trade price action. The majority of investors focus on price-to-earnings ratios, sales growth, earnings growth, and supply and demand when trying to value markets. Technical traders look at price action on charts to see what price levels the other market participants are buying and selling. Moving averages is a price filter for traders to get a wider view of trends than just price alone. Your goal as a trader is to develop ways to capture trends inside your time frame, through quantified methods based on proven principles and back-tested market studies. Moving averages are one of the best tools for quantifying this. The incorporation of moving averages as trading signals removes much of the emotions and opinions that tend to get traders into trouble. Moving averages are great guides for entries, exits, position sizing, and providing a filter to view the actions of buyers and sellers in a market. Price is the result of an agreement between the buyer and the seller at any given moment. Your purpose is to be on the right side of key moving averages as a market or asset is being accumulated or distributed inside your trading time frame. Profitable trading is the result of making better decisions than the majority of traders that are on the wrong side of a key moving average in your market. Some quantifiable signals for entering trades. Intraday momentum by signals as price breaks above key moving averages on daily charts. End-of-day momentum by signals as price breaks and closes above key moving averages on daily charts. Next-day momentum by signals as price breaks and closes above key moving averages on daily charts from the previous close. Buying support as price pulls back and holds above a key moving average, buying as price reverses and breaks back above a key moving average after being on the other side of it in a downtrend. Buying a pullback to a supporting moving average in a trend. Selling short into a moving average, acting as resistance in a downtrend, buying when a shorter-term moving average crosses over a longer-term moving average. Selling short when a longer-term moving average crosses under a shorter-term moving average. Possible ways to place stop losses after entry. A key moving average does not hold as support for a long position. A key moving average that has acted as resistance is broken through on a short position. It gives a trader better odds to stay in a good trade if you set your stop a few percent below a key moving average to avoid the obvious levels being hit. An end-of-day stop, if price closes on the wrong side of your key moving average. A next-day stop, you close a position on the next open if your key moving average is violated. A moving average crossover. Potential ways to set a trailing stop. If you enter a trade based on a longer-term moving average like the 100-day or the 200-day, and it has gone into an extended profit, you can move your stop up to the 5-day or 10-day moving average. Set a trailing stop at a loss of the previous day's low or high of day. Exit with profits. Price crosses back under your initial moving average after holding it through a profitable trend. The RSI can be used to exit a trade for maximum profit after entering based on a moving average. Exiting your position when it becomes overbought or oversold. Exit if the Bollinger Band is broken. Exit if your profit target is reached. Remember: 1. Momentum entry signals are based on the beginning of a strong move through, and breakout of, a short-term trading range. Momentum trades are based on the principle of even higher highs or lower lows on a chart, based on a new trading range and trend. Momentum is usually a short-term trade. Momentum traders are looking to capitalize on a move and then get out into the follow-through strength. This is where the 5-day EMA and 10-day EMA are used. 2. A trend trade is where you enter with the flow of the market's trend of higher highs and higher lows, or lower highs and lower lows, in your own time frame. Trends can also be measured by moving averages that are going higher or lower on the chart. This is where you use the 50-day and 100-day moving averages to capture a longer-term trend of weeks and months. 3. A trend-following trade attempts to capture an entire trend, and will give back paper profits in search for these longer-term trends. Trend followers can capture trends that go on for years. Trend followers also tend to get out of markets as trends begin to shift, and can make money taking short positions in downtrending markets. The 200-day is the moving average the majority of them key off of. 4. Moving averages are not very useful tools for swing trading tightly range-bound markets. They are primarily for trading trends or deep swings inside of long-term trends. Some traders look for signs that a moving average in their time frame is beginning to slope upwards or downwards, and consider it one indicator of a trend beginning, continuing, or changing. There are no magic moving averages that always lead to profitability. There are only those that allow you to make money during trends based on your own personality, risk tolerance, and time frame. Each trader must decide how to incorporate moving averages into their own system and time frame. Moving averages are best used for trend identification and trailing stops after entries are taken based on other technical parameters. While single moving averages are not standalone signals for creating trading systems, they are one of many tools that a trader can use for signals inside their trading plan. It is possible to use moving averages as standalone signals to trade individual stocks and commodities that are under heavy accumulation or distribution, if you keep your losses small and let your winners run. High volatility is the biggest enemy of trading with short-term moving averages on a daily chart, because they are not respected during price range expansion and can cause multiple losing trades before catching a winning trade. Using moving averages of longer time frames like the 50-day, 100-day, and 200-day is a way to filter out much of the noise on the intraday and daily charts, but the trader will have to accept larger drawdowns in account capital during the volatile price moves, even in stronger long-term trends. Moving averages can be the most valuable tool in your trading toolbox if you use them to quantify your entries and exits inside of a robust trading system. Moving averages are one of the easiest and fastest ways to quantify the trend in specific time frames. In this course we will now explore specifically how I use them in my personal trading. What we learned. Moving averages can show traders and investors the buying and selling behaviors of market participants. Moving averages can be used to identify a trend by what side of it prices are trending on. Moving averages can be used to quantify current trade decisions based on the trend of previous price action. Moving average breakouts can be used as momentum buy and sell signals. Key moving average support levels can be used as dip buying opportunities. Moving averages can be used in quantifying hard stops, stop losses, and trailing stops. Moving averages can be part of a trading plan and trading system after a market's key moving averages are understood.
Thanks for watching. I will upload a video every day with tips and solutions. So, for more, please like it and subscribe. It's free. Bye bye.